Hey everyone, Sloan here, and as usual, I have a podcast episode that's worth a little bit of excitement on your part. Our guest in this episode, Ulf Erlandsson, is the founder of the Anthropocene Fixed Income Institute. That name, Anthropocene, refers to the present geological epoch, where human actions are clearly the dominant influence on climate and the environment. A portfolio manager turned activist, Ulf takes us inside some recent fixed income transactions that suggest some banks and some pensions are taking their commitments to ESG less than fully seriously. He then disaggregates the yield pickup that buyers of fossil fuel have been feasting on, or fossil fuel debt have been feasting on, explains how his activist ESG strategy benefits from fixed income trading's nature as a primary market, and talks about how pensions can profit from sustainable fixed income strategies. It's enough to give the lefty finance types that listen to this podcast the vapors, but in a totally safe way, we promise. If you're looking forward to listening in, I have just one favor to ask. That, of course, is to leave some love for us in your podcast app store of choice. You should also check out the ever more relevant blog on freemoneypodcast.com if the inspiration strikes you. That's all for now. Enjoy.
Here comes the money.
Here we go. Money talk.
Here comes the money. Money, money, money.
Dollar, dollar.
Now, welcome to the Free Money Podcast. This is where we bring you the Brooklyn Bay Area consensus about institutional investing that you, in fact, desperately crave.
You do. You even
Yeah.
crave it when you're in 122 degrees in Phoenix, Arizona, I believe so.
Yeah, my partner's family is from Phoenix, Arizona, and I was just out there visiting at the best time of the year.
Did you get some record temperatures while you were there, catching some of the climate change?
Yeah. Yeah, well, it's a dry heat.
That's right.
So it being 18 degrees basically every single day is, it's not as bad as it could be.
It's 72 in the shade.
I don't know what these liberals are making such a fuss about. It is really crazy. Apparently, the Arctic Circle's air temperature, like up over like in the Russian Arctic Circle, and Arizona's air temperature were the same last week.
I saw you post that on the Twitter sphere.
Yeah.
I think I liked it, but I liked it with I wish there was like a fear. I fear. I want there to be an option on Twitter now, which is like, I fear this.
Yeah. Well, that's probably appropriate for everything I post on Twitter.
That's true. But it was wild. I can't believe that. I didn't know it could get so hot there. I don't think it's supposed to.
It's definitely not supposed to. And like when it like heats up like that, the permafrost releases methane gas.
Yeah.
And just kind of like it permeates the atmosphere.
And it
really,
probably
really
releases like the alien technology that was dropped there thousands of years ago and is now being thawed. Or Captain America.
Yep. Well, but I mean, that's it. The alien technology angle is something that we don't hear enough from climate change advocates.
No.
Because, there is a definite, like, being in a sci-fi movie angle here.
And part of us, and that, I mean, me and you, Sloan, part of us wants to build an info wars on the left here, so we can mostly so we can sell our sports drinks.
Yeah. And also those, we talked last week about the climate credits, And actually, I don't know if we talked about this last week, but, a common gardening product is actually one of the worst things you can have for climate change. Peat moss.
Oh.
It is in every gardening product.
Interesting.
And it is the worst thing for the environment. Like, it's nature's most efficient carbon sink. The only way to get it out of the ground is to strip mine it. And when you take it out of the ground, not only does it no longer sequester carbon, but it re-releases all that carbon into the atmosphere.
Oh my goodness. I'm not using that stuff, people out there. Just so you know, my personal garden has no peat moss, so I'm still waiting for the contributions. So you can earn carbon credits.
Yep.
My personal story before we get into the news, Sloan, I was at a party yesterday.
Holy
actual
shit.
Human party. This is not like a party of dogs at the dog park. Probably like 100 people at a house in Woodside with a food truck. We were outside but still, I don't think I saw a mask.
Wow. What was it like? Did people like remember how to socialize?
No, we didn't. Especially me. I kind of stood by. I just stood and kind of like drank my Chardonnay until I was sufficiently Chardonnayed. And then I was very entertaining. I'm sure, but It was wild. It does feel like, you were in Phoenix. I was at a party. Maybe the pandemic's over? Question mark.
Yeah. I mean, like people certainly are acting that way. I mean, like the plane that I was on was full both ways.
Wow.
The people were pretty good about masks, but like it's still, the caution level is definitely down, maybe to like light yellow, if not, light green.
I do hear New York is just going off right now, and it's like the coolest place on earth to be.
It's pretty lit here.
Yeah.
Yeah, and it's Pride Week, which is always pretty lit here. I just got off the phone with a friend who was like DJing until like 1:30 a.m. last night at an event.
That's awesome.
And, yeah, it's
DJs.
I know over one DJ.
You know DJs. That's amazing. I don't know any DJs.
I mean, stick with me.
On that bombshell, shall I jump into the news?
Yeah, do it.
I got some good news. Well, no, actually, I have interesting news. I have bad news, but it's interesting. First and foremost, Australian Sovereign Wealth Fund CIO Susan Brake or Brackey, I'm not exactly sure how to pronounce her last name, but she's out there saying that they are building up huge positions of cash, which is never a great sign.
That's a great sign. Yeah.
In a bid to be able to move quickly when markets get jittery over the inflation and how central banks are going to react. So you're seeing a lot of the asset owner community starting to say, look, this is getting a little toppy, and inflation. We're seeing a lot of, news out there about inflation. And so now some of the smarter, biggest sovereign funds are saying, look, we're getting ready.
I love that. That's cash as an option. I mean, like, it really is like one of the cooler things in portfolio management. You can just not own something, and then you have the ability to own something later. It's a beautiful option.
I also find it interesting that normally when you're worried about inflation, the one thing you don't want to hold is cash.
Yeah.
And yet, so like they are next level ninjas because like, look, for those of you out there that, are worried about inflation, don't take cash and put it under your mattress. That's like the worst thing you can do. They will invest this cash. That's what the plan is.
Yeah, exactly. Like a lot of retail investors will probably mimic that and then like forget to reallocate.
Exactly. Exactly. And then they'll look back after hyperinflation and be like, oh no.
Yeah, I mean, at least in hyperinflation, stock prices tend to go up.
True. Get your cash into stocks is what you should be doing. But what they're saying is interest rates will come up to prevent real inflation, and it's the interest rates rising that will force markets down. So
that makes there's been a lot of fear about that. I mean, the Fed is always saying 2022, we're going to be data dependent, which is kind of a conflict, right? You can't say you're data dependent and then say we're not doing it for another year.
True.
Like that doesn't make any sense.
True.
But yeah, it's like it is the big fear all of a sudden, which honestly, great news for the economy. I mean, like pretty much my whole time being cognizant of investment stuff, everyone's been like, inflation's going to come, inflation's going to come, inflation's going to come. And it's never come.
Yep. It's like the low return environment that we were worried about a decade ago. Like, we're in this low return environment. It's going to be so hard to generate returns. Just go have a look at the last 10 years.
Yeah, some of the dankest returns there have been ever. Yeah,
dankest. I love it. So look, this feeds into my next story, which we could be breaking news right now. I want you to know I'm coming to you live with an anonymous source who tells me that large pension funds in America are being told by their consultants and service providers that their capital market assumptions will be far lower this year than they've ever been. Which means, for those of us inside the baseball diamond, that their expected return numbers will be coming down, which means their liabilities are going to go up, which means our taxes could go up in certain states. So what does all this mean? When you're setting an expected return target, you go around and you collect a whole series of assumptions about what different markets will do in terms of performance. Equity markets in America, fixed income markets, real estate markets, private equity markets. And these consultants and service providers tell you, here's what you can expect. Then you bake that into an expected return for the entire portfolio. And ideally, if you're an American pension plan, you want that number to be near 7.
Yep.
Many people can't even get their CMAs to get to 6. which
I mean,
means
that makes sense.
it does make sense when you look at the world, right? But
Yeah.
but I'm like getting hit by a lot of people in the industry that are like, Ashby, how do we carve out that extra 1% to get from 6 to 7? And this is the moment I've been waiting for, where I'm like, do something innovative.
Yeah,
Been waiting
it's
my
like,
life
grow
for
up,
this
guys.
moment, and
Yeah,
and so we'll see. I've got Eminem playing in the background, Mom
Mhm.
Spaghetti on the
Oh,
stove.
what? I mean, they must be reading the Free Money Podcast blog. I mean,
I think
like,
they are.
we had a post up there like a couple weeks ago about GMO, which I guess is short for Grantham Mayo Von Otterloo and Company, but it should be like short for like Grumpy Man.
I once interviewed Grantham.
Oh, he's such a cool guy.
He's the coolest dude. We were on stage, and the thing he freaked me out about is that the couch I'm sitting on is filling my body with chemicals I don't understand.
Yep.
And I was like,
I mean,
this is the craziest conversation I've ever had. I had no idea I had all these chemicals in my body.
yeah, I mean, and their latest CMA, like, they're negative on everything except for small cap emerging market stocks.
Oh my
which,
goodness.
like, who has a small cap emerging market sleeve operative in their
Very
portfolio?
few. Not the big
Yeah.
guys.
You can't do it.
Yeah,
You can't do it.
doesn't
It's
scale.
like, yeah, you can't cut a big check there.
All right, 2 quick bits of news. I think this news I'm about to say we got to come back to, because I feel obligated to say the word DeFi on the Free Money Podcast. DeFi, decentralized finance, has taken. I can't go 22 seconds without having somebody ask me my views on DeFi, and I defy that DeFi trend. But here we are talking about it. So DeFi is decentralized finance. And I just wanted to flag for people, this is the new umbrella term for blockchain, crypto, Bitcoin. And it is what people are starting to call the FinTech 3.0. And I just wanted to
Oh, it's a 3.0 now.
Oh, we're
Wow.
3.0. Oh, you thought we were 2.0? Oh, this is 3.0. This is DeFi. So we got to come back to this, Sloan. Okay, this is a topic for a future day. But now everybody out there knows when you're at the cocktail party, you know enough to be dangerous. Just say you're really excited about blockchain and you're tracking stable coins. Okay, you'll sound like a champion in the DeFi chat.
And if anyone out there has somebody that they think would be an unbelievable genius for us to interview, hit us up.
Oh yeah,
I mean, like a suggestion is great.
We need to do crowdsourcing of interview guests.
Yeah,
that's
we
genius.
should.
And by the way, like and subscribe.
Oh yeah,
like and subscribe. Last piece of news comes to you from Korea. Korea Investment Corporation just came out with its second annual sustainable investment report. And they reported that in the last year, they have invested $1.79 billion in ESG bonds. And that sounds super exciting.
It's a lot of money.
It's a lot of money, and it sounds exciting. I don't know what ESG bonds are, though, exactly. I'm assuming it's like bonds that have some reporting requirements, or maybe it's like even impact metrics that they're tracking. There's green bonds out there. There's even blue bonds related to clean water. I'm guessing that's what they're referring to, but it'd be great to get more information on that as well.
So funny you bring that up. Our guest today, in a pure coincidence, our guest today is Ulf Erlandsson, whose name I probably did not pronounce right, who heads the Anthropocene Fixed Income Institute out of Sweden. And, Anthropocene, of course, being the name for the geological epoch that we now sit in, where the dominant force affecting climate and the environment is human behavior, right?
Fascinating.
So I'm really, really excited to get him in here. Let's just go ahead and do it.
Let's admit, Ulf.
Hi.
How are you?
Oh,
great, Ulf. Thanks for joining us.
Thank you very much. My pleasure.
Where are we talking to you right now?
You're talking to me in Stockholm. Where are you? You both in New York, right?
No, I'm in California. This is the Brooklyn Bay Area consensus. So I got the Bay Area. I got the Bay Area side of things.
All right.
How is Stockholm right now? Are you on one of the many islands?
Yeah, I am actually. I'm sitting in Old Town, so it's like all
Okay.
the 15th century and stuff.
Oh, I love that.
Whereabouts in California are you?
This is a little town called Los Gatos, which
Okay.
is south of
The Cats.
Yeah, it's the Cats for those in the know, and it's south of Stanford University, where I'm on research faculty. So, yeah, it's nice. But we were just talking about fixed income and the need to like unravel some of the stuff I think you've been working on, and it's just awesome to have you here.
Yeah, and Ulf, I mean, I think the best place to start, you were like roasting a transaction that Saudi Aramco did recently, the last time when we chatted last week. And, they did a sale and leaseback of some pipeline assets that I know, some pension funds, bought into, shame. Maybe can you take us inside that and kind of the absurdity of it?
Yeah, I mean, let's start with the basics of this thing. It's big, right? It's between 10 and 12.5 billion US dollars, which makes it bigger than even, Saudi Aramco's bond issuances that they've done historically. So it's a big transaction. The money is essentially being used to pay dividends to, the kingdom, MBS, etc. So it's 98% owned. Ownership of the company. So, and when they're not generating enough cash flow, they need to pay money to the kingdom anyhow. So that's essentially the background for this one. So what's happening is the fact that Aramco has all of these pipelines within Saudi Arabia, and they're saying that, okay, what about if we offload these from our balance sheet for a while, get some cash, and then we get them back after a couple of decades or so. So the transaction is structured essentially as a lease and lease back, but the investors more or less they buy the pipelines for a duration of 25 years, and then they get paid tariffs by Aramco for using the pipelines, and then after 25 years they actually give it back to Aramco. So that's the basics of the transaction, the credit side of it. Then the financial engineering around this is pretty interesting, right? So there's lots of different counterparties working with this. The main buyer that came out for this is a firm called EIG, which is a US-based, Washington-based investment firm with lots of sort of connections into institutional money, even US pension funds, etc. It's interesting because they finished the transaction. Other big guys like BlackRock, Brookfield stepped out of it earlier on. So, I'm not going to tell why they did that. But it isn't a particularly popular exposure to have in the days of ESG, etc.
Yeah. Yeah, and the collateral of pipelines in Saudi Arabia, I mean, sounds like it's really easy to seize in the event of an issue.
Yeah. I mean,
Sounds like that's not one of KIC's ESG bonds that they're holding.
Well, it sounds like one of those. If you go there and try to seize assets, you're going to get yourself a hotel room at the Ritz for an extended period of time, or your embassy and sort of reclaim it as well. And that's half joking, half serious. It's a big thing in credit, right? If you're doing something which is asset backing, you seize the collateral, and I'd put pretty substantial question marks around that in this transaction.
Yeah, and obviously the the misalignment with the stated ESG mandates of many pensions is pretty fun. I mean, we're talking about a fossil fuel pipeline for the next 25 years. That's a while.
Well, I mean, to be fair, 2045 is within the realm of net zero in 2050. So if you're a bank like HSBC, for example, promising their shareholders net zero by 2050, well, this is good. This works, because this is going to be off after that one. Now, there's been some even more interesting developments on this thing. So Bloomberg reported, and this is from third-party sources, so I don't want to get it ascribed to myself. But apparently there was a swap transaction involved. So essentially they swap the floating versus the fixed interest rate in this transaction. And JP Morgan walked out with a cool $100 million of P&L on the back of that transaction. They haven't monetized it as of yet, but that's the P&L they made just in like the first couple of months on this one. And they were the sole bank on that swap transaction, which is Interesting to say, and I'm not blaming them. They're a bank; they're supposed to make money. I guess the EIG guys should be a little bit considerate about who gave them the advice with regards to getting into that swap, because they lost the money.
Yeah, and I mean, like, speaking of yield, right? Like, I mean, I think a lot of the reason that people would get interested in a transaction like this is because of the potential for like a yield pickup, right? I mean, there's, they pay higher coupon rates often these fossil fuel transactions. But you sort of explained that it kind of evaporates under a little bit of scrutiny and with a little bit of creative financial engineering. Can you sort of take us inside that a little bit?
Well, it's pretty down to basics of credit pricing and credit analysis, right? What we're trading is really some sort of interest rate risk, and then we're trading default risk. So the probability that I will not get my money repaid. Now, what's happening right now is that a lot of companies, well, you'd say Exxon or Aramco or some of the big fossil guys, they have very high credit ratings right now because they are not a big credit risk within the next 5 years, and that is essentially how far the perspective of the rating agencies go. Now, when you go out to the 10-year point, if you're comparing a double A rated bond with another double A rated bond, well, it's actually the market is starting to price in other types of default risk, underlying default risks in there, which might not be reflected in the credit rating, because credit ratings are trying to predict defaults. But there might be divergences, and especially when you start talking about like a 10-year horizon, a lot of stuff's going to happen with climate change, and for a company that hasn't transitioned its business model, tentatively, the default risk will be higher in 10 years, and that's not a risk-free arbitrage. It's you buying one risk that, well, you think it's mispriced, but the rest of the market might not think of it. And then bring on the flow factor. I mean, if we get to tail risk scenario, let's say you get 115 degrees Fahrenheit temperatures to California, and people start saying, yeah, we're not going to invest in fossils anymore, and the market has some sort of event that makes it go negative. Well, the liquidity factor in some of those fossil risk related bonds is going to be impaired, I think, and that needs to be priced in as well. So you pick up, there isn't a thing as a as a free lunch, unless you're a hold to maturity investor, and if you're that, we can have that discussion outside in the back alley.
Yeah, where you will get spanked probably, and hopefully those 150 degree temperatures in California, by the way, not theoretical. That happened last week in Palm Springs.
I am reading up my case. So.
I guess the thing that's really interesting about this, as a sort of venue for ESG engagement, of course, is that fixed income is a primary market, right? Like these transactions are between issuers and lenders, and the company actually is directly affected by the nature of the transaction. How does that sort of change the tools and tactics that you use in activist engagements?
Well, it's very clear, right? Because if you're engaging in a primary market activity, you're shifting a basic supply and demand equation. And once you start shifting that, if a big investor pulls out of some certain fossil deals, well, there's less demand to buy those bonds, and you have to readjust the price, i.e. the yield needs to be going up in order to compensate investors. Another way around, if you're sort of helping out in the primary market transactions, that's decreasing the yield, decreasing the cost of capital. But the cool thing here is that it actually gets translated straight into the cash flow of the fossil sort of projects in some sense. So if all the banks help out Saudi Aramco on this transaction, so they actually get the lower yield on their borrowing that they're effectively making on the back of this leaseback operation, well, that means that they're paying less money, they're paying less bills by the end of the month or by the end of the quarter in this case, and hence everything which is engaging to sort of supply finance to the fossil fuel sector in the primary market, it's not a victim of this. Not one seller is another buyer. Type of critique. It's actually shifting the basic fundamental supply and demand equations.
It's really interesting to hear about these dynamics. I think one of the things we spend a ton of time on the Free Money podcast thinking about are the pension and sovereign fund, just the giant asset owner investors in the space, and the influence that they can kind of have over this broader market. It's our kind of working assumption that these are big long-term investors, so they should care about these issues, but also they have stakeholders that just are kind of inherently interested in living on the earth for a long time.
Weird.
What, like, in your expert opinion, like, what sort of role do pension funds and sovereign wealth funds play in this broader market? And could we be kind of helping them become better ESG advocates in this space?
I mean, they play a huge role, especially in fixed income, which is sort of clubby. You don't have a gazillion retail investors. You have a couple of big guys. I jokingly say that, no one who matters in fixed income does not have a Bloomberg terminal. Don't get me wrong on that. That's not like a marketing statement or anything, but essentially that says that,
They all have one.
yeah,
Is
well,
that double negative? Yeah, okay.
They're juniors too, right? Otherwise, they can't transact in that market, which limits the number of Bloomberg terminals across the world. So that was like 25K. So, there's a limited set of people who can actually engage in this. Now, we did a pretty cool thing back in November, actually, with the NGO I represented, where there was a big case where an Indian bank called State Bank of India was going to give a massive $70 million loan to a company was going to build a big coal mine in Australia. And because I tend to come from the institutional investor side, I called some of the people I know there and said, hey guys, you invested in the green bonds from this State Bank of India place. Now you need to call them and say, we cannot accept that you're actually doing this transaction. And the thing is, they get an audience with State Bank of India Treasury, or it's almost like the reverse way. The treasurers at State Bank of India, they got overwhelmed with like calls from like sort of semi-big guys to begin with, but then you had like the Norwegian Oil Fund, you had BlackRock, you had Storebrand, you had a couple of the big guys calling in and saying, yeah, don't do that loan. And by the end of the day, they decided, yeah, we're not going to do it. It's not worth alienating our investor base on the fixed income side in order to just give this sort of semi-political favor. So it is.
My gosh,
it's cool. It's pretty cool.
Yeah, that is. It's like almost gives me optimism that like these organizations.
Far, okay?
Yeah, let's not. Okay, fine. I see optimism in my future.
Today we're looking at the market event where Enbridge, Pipeline 3, Canadian tar sands, all of that, they're looking to do their first sustainability-linked bond in the market, which, let's say we have a certain queasiness around that.
Yeah, I saw your note about that. I mean, this, imagine the audacity of putting out a bond like that, where you basically already met the targets, and they're both irrelevant and self-reported.
I'm just like the audacity. That's exactly. I think I'm pretty scarred from a career in bond trading, but some of the stuff comes out. I mean, it's just like.
But let's talk for a second about these sustainability bonds. Like we've already talked on the show about green bonds, blue bonds, and I know even some of the big pensions and sovereign funds are issuers of these bonds. Canada Pension Plan, I think, did a green bond at one point over the last few years. What do you feel like this is a market that's going to scale? Is this the pathway to really build green exposures, the green bond space, or do you have some other kind of ideas on how we can help these big investors get access to sustainable fixed income?
I think we're already seeing it happen. I mean, the fact that Enbridge is trying to do it, although not very well, poorly advised by their banks, I must say as well, is saying something that people are trying to tap into this sort of pool of interest, etc. So that's an important dimension. Now, a factor I think is really crucial, and this is really where I come from, because I did a lot of green bonds, but I didn't start out there. And the reason that the franchise I was running back at AP4 became big in green bonds was the fact that I didn't pigeonhole them. So to quote Patrick Swayze in that great movie, nobody puts green bonds in the corner. Paraphrase it. Sorry.
Love it. No, that's great. We love Patrick Swayze on the program.
It doesn't, right? And this is going to a slightly older generation listening to this, I presume. The Zoomers won't get it. But anyhow, the fact that, once you get the green bonds, the sustainability linked bonds into the traditional mainstream bond portfolios, that's where you hit the wow moment, where like you can shift in. It's not going to be your pigeonhole. I can take $1 million positions. It's going to be, okay, I'm switching out of this bond where I have a $50 million exposure, and I want to look to get that same type of exposure when I'm switching into this, the green bond of the same issuer. That's really when it hits home. But there's just like such a powerful incentive as well, that where we, like, through the green bonds, we're getting like the DNA of sustainability into the thinking of the treasury function of the issuers. They start thinking about environmental KPIs and stuff. They never cared about that before. I mean, it was like in the environmental ESG group, the sort of elephant's graveyard. That was the way it used to be in Scandinavia, and I think it is in a lot of places. And it suddenly becomes like a trading thing. It becomes like a markets thing, and you can't sort of retract that. It's just gonna keep on rolling.
That ties right into like a very kind of recurring free money theme, which is like, these innovation thing, like these innovative silos wind up having really broad effects on the broader organization, beyond just like the issuance of one bond.
And I think you nailed it by saying that the objective here is to move these ESG indicators into the core traditional financial risk teams. And once you can kind of integrate the data, the risk, and the ESG around a single strategy, then you really actually start to move capital markets. I'd never heard the elephant's graveyard analogy before, but we see it here and really around the world, where the ESG teams are kind of often relegated, sitting in a different zip code from the investment teams.
Yeah, I'll give you a local example. So, for example, we did a note a little while back where looking at just like the biggest flarer of the Permian Basin, so a company called Ameridev, owned by private equity. And who are the investors in the private equity? Well, the biggest one in that fund, which actually invested in Ameridev, is Cal STRS. And that's not on the package of their ESG group definitions also. So there's a movement now where not taking care of these things, that becomes like a reputational, like a business risk. It's not only about making you look good in the sustainability report. There's going to be some pretty nice people personally, but when they come to professional role, it might be slightly nasty. Who's going to challenge you on that? And going to tell you, your fixed income book looks like it's very tilted to some of the stuff that you're saying that you're against. How does that come? That's people should hedge themselves from that, I think.
There's a very like interesting lesson, because I know that there are people listening to this podcast who either are on their way to a desk at one of these pension funds or are sitting at a desk at one of these pension funds. And you mentioned like the pigeonholing of green bonds, and by not holding yourself out as a green bonds person, you were able to do more in that space. I wonder, what advice would you have for the kind of you 10 years ago that might be sitting in these spaces right now?
The advice I would do, and this is from being smart and being the biggest sort of climate impact thing you want to do as well, is to look at your portfolio. Don't get involved and think too much about the green bonds. Buy some of them, it's pretty much the same. But look at the baddies in your portfolio, the ones where the names aren't smelling fresh, because that's what's going to come and bite you. We pushed the Danish pension fund called PFA with regards to their exposures to being the third biggest lenders to the province of Alberta in various currencies. And Alberta uses that money to subsidize oil sands industry, and that doesn't look good for their end pensioners, and they have to change that. And it's like manage your career risk, man. Just don't. Why should you own something for a few basis points more, which isn't even like a risk arbitrage, if it's going to lose you your job? I mean, we're a conservative industry, and a lot of us will be sort of career risk focused, and owning deep fossil risks right now, that's career risk. So it's just like
I love how you like flipped the career risk around. It's now playing in our favor. It's like a judo move on career risk. It used to be that people, they viewed their career risk as being, oh well, I just need to invest in all the private equity funds because that's what all my partners are doing or my peers are doing. And now it sounds like what you're saying is actually the career risk is just doing the status quo. If you keep doing the status quo, like there's a creeping career risk coming along.
Yeah. No, I mean, that's it. Like, if you stay still, you're at risk. You have to be in motion. And where is the secular trend going? Well, it's not going towards leveraging up on fossil assets. So start moving along with that secular trend. Be ahead of the curve rather than behind the curve, because that tends to be a pretty good P&L trade. And you don't have to be the smartest guy in the room. Just look at the trend, right? And don't own assets that you would be queasy about telling your kids that I lowered the cost of capital for this coal mine or this oil sand in situ site or whatever.
Yeah, well, and folks who want to hear from one of the smarter guys in the room should make sure and check you out at afii.org. Great email list that is pretty active, and thank you so much for hopping on the pod. I know that there is a Euro Cup game that is of the utmost importance right now. Who's Sweden playing?
Sweden is playing Poland, so it's essentially renewables versus coal here. So.
Oh, that's hilarious. Well, thanks, Ulf. Really appreciate it.
Thank
awesome
you.
Insight.
Thanks so
Thank
much.
you for having me. Thank you.
What a great insight. I mean, I love how he just inverts a lot of the conventional thinking. And
I love it too.
There's a clarity that fixed income analysts have about stuff that I find really enviable. Because like whenever you talk to equity people, it's jazz hands and honeybees and happiness, and like hopes for the future. But on the credit space, you're talking about pinching a basis point here, a basis point there, and that's the ball game.
Yeah, well,
you got to go deep into the analysis.
On one, the upside is endless, and on the other, the downside is endless. So equity people are notoriously optimistic, and fixed income people are notoriously pessimistic. Right? That's the stereotype. Yeah. But I love his "if you stay still, you're at risk" comment. Because that does like resonate, because that's that fixed income, he's constantly looking for the risks in a fixed income product, but it also applies to the career and the individual. And so, he's realized that like the world is moving around these folks and they got to do something. So it's a fabulous guest. I didn't realize I probably should have known this. I didn't realize he had been at AP4.
I probably should have told you that.
I was just reading all of his blogs ahead of time, but and I thought those were. I love how he was calling out CalSTRS.
Yeah, I mean that's a real broadening of our historical trolling of the California-based large pension funds. I mean, like historically, it's been very CalPERS oriented.
Yeah, no, we definitely got to bring in CalSTRS from time to time. That was fabulous.
Yeah, but. You know exactly what time it is. It is time for Dear Ashby. This is a segment where, if you're following along at home, we answer your questions. And, ask them if you have them. Send us an email at freemoneypod@gmail.com. You can also hop on freemoneypodcast.com, and there's a form on there that allegedly works, but none of you are using it.
We have a website and an email address.
I know.
Very
it's very
tech forward.
It's very official, and the logo and everything.
It's beautiful.
The first question comes from someone who seems to have been hanging out on Wall Street Bets forums or something like that. I
think we probably introduced them to Wall Street Bets forum. That may have been our fault.
Can you imagine? Yeah, people are out here trying to ape Liz's investment strategy.
Right. Liz, how do you do research? I don't.
I buy the longest one.
That was it. Literally her advice was to see the page count on the research and then back that.
I mean, hey, it's a strategy.
It is.
Say whatever you want.
All right, what do we got?
This one is, relatively short in page count. I see lots of charts with lines and bars on them, which purport to say something interesting. Should I learn how to read them? I think they're talking about technical analysis.
Fantastic question. Going back to everybody who's ever taken an investment class has been warned not to believe the, what's going on in the technical analysis. But there's an interesting, take here, which is that technical analysis is really the predecessor of quantitative investing. And like, if you go back 50 years, the quants were doing technical analysis. They were just studying the heads and the shoulders and, like all the different types of trends, basically, that you see in pricing. The point of the technical analysis is that it's devoid of understanding of the company, right? So you're really looking for price and market interaction and trying to extract some insight around future price. And it turns out from quants, we know that there is actually predictive capacity in just price movements. You can start to predict regime changes, and those regime changes can drive momentum, and momentum then builds more, price movements. So all that is to say, I think there is something there that's interesting, but it also is like, what leeches are to healthcare. Technical analysis is to quantitative investing. And so just think about how often you would use leeches to solve problems, or frankly, astrology instead of astronomy.
Hey, that's queerphobic, Ashby. You can't talk shit about astrology.
I can't.
In this political
sincere
climate.
Apologies. Sincere apologies.
I mean, but it is cool. It's like they're an attempt to piece out private information from public information, right? Like, as you can see, like, prices where people are accumulating, prices where people are selling. There's not nothing to it, but there's much less to it than people make out.
Yeah, and there's much more you can do than technical. Like, if you're really interested in the foundations of technical analysis, which is price movements, then build some algorithms instead of learning how to chart. I would say learn how to do quantitative analysis. There you go.
Yep. All right, that's a good answer. I guess this is a DeFi related question. Although we do not have that hashtag in the question. The listener asks, cryptocurrencies in aggregate went from about 0.5% to almost 4% of the Wilshire 5000 market cap during the pandemic. What would Jack Bogle say?
Part of me thinks he's rolling over in a grave somewhere, but he'd probably say, let's build a diversified set of exposures to these things and package them up in an index fund and allow you to participate in the growth of the market without taking the idiosyncratic risk of any single coin or cryptocurrency.
Yep.
I think what Jack, the big invention for him was passive investing and the ability to participate in the growth of markets. And so he might say, what an interesting market, if you really do believe in DeFi and FinTech 3.0, why not build some passive exposure? And frankly, does that exist yet? Is there a kind of ETF out there that we can buy that will give us access to, 30, 40, 50 different cryptocurrencies? I don't know.
I think that there are some exchange traded notes, but they tend to trade at a premium or a discount to the underlying, because they, it's kind of that old thing where it's like a basket of futures or whatever, and there's all kinds of arbitrage that's happening around it. But yeah, I mean, it also is funny to think about this because, Jack Bogle, of course, had a long career. And in the early part of his career, he was like a go-go fund manager in the 60s. And he was like out here hyping all of the stuff like, National Cash Register and all the growth stocks of that era.
Was he really?
Yeah. So like, that's actually he wrote a thesis on, for listeners, I got to interview Jack Bogle at my old gig. It was really cool.
That is cool.
But he got really, really into all this stuff, and then he got burnt terribly. And that's what kind of led him to create this, what they called Bogle's Folly at the time. Anyway, the last question.
Here we go.
And this one comes from me.
Okay.
I know active management is a cursed undertaking, but I can't find any existing funds that align well with my values. Is it insane to start a new one?
That's hilarious. All right, so I'll tone down my messaging now that I know it's from
crazy.
you.
You lunatic. Well, Claire and I are like, we've started looking at our stuff and we're like, there must be some ESG fund out there that will like, do veganism and do
interesting.
like,
yeah.
the like, and it's just, I'm not finding a thing. I'm finding like lots of people who are willing to sell me like Microsoft ESG funds, where it's just like, oh, Facebook is our top holding. It's great. They don't emit any carbon.
Okay. So I'm literally on the fly. I'm going to change my answer a little bit, which is I'm going to do it live. Okay. The answer here is it is such a crowded field that it feels like there should be stuff.
Yeah.
But actually, you're right to point out that when you dig into the entire ecosystem, the ESG, world of investment opportunities feels pretty homogenous. Yep. And it's like the same damn, public equity products, just like being powered by different data providers. We did have a guest on the show not long ago, Jay Lippman from Ethic.
Yeah.
Which is a fund manager that purports to allow you or allow your RIA. So it's not, you have to have an RIA, registered investment advisor. It's not a direct to consumer offering, but they do purport to allow RIAs to help their customers invest with their, wait for it, ethics. And it can be tailored. So the neat part about their technology is you're like, I care about guns and I care about fossil fuels. Well, you can get rid of them in your portfolio, and then they can build an index that has the same tracking error and risk as the sort of standard benchmarks. There's a few companies like that emerging. Not enough of them are direct to consumer, which is the problem. And so you're out there looking around for standard ETFs that are, matching your objectives. That's really hard. That's really hard to find.
I just want an iShares. I want an iShares fund that I can pay 50 basis points for that will like simply not involve animal cruelty.
Yeah. But this is, this will become mass customization, right? Where we all get the chance to say, actually, this is what I care about, but I don't want to go through the process of freaking building my own index. And
it's insane.
So somebody needs to come along and say, here is the tailored index just for you.
Yep.
And that's probably a startup project rather than a mainstream asset management project. So that's where I would look going forward.
That's probably right. Yeah. Maybe we should get coffee with Jay.
Yeah. See what's up.
They're based in New York. But yeah, that does it for today. I mean, what an episode.
What a fantastic episode.
Yeah. I mean, if you're listening and you haven't already subscribed and liked and shared and whatever, I just don't know what to do for you.
Yeah, not just like. I
mean,
5-star.
5-star. Yeah. We're up to 8 5-star reviews.
Wow.
Now,
so these constant requests really are having an effect.
Yeah, exactly.
I mean, every time we ask, we get 1/4 of a rating.
That's true. That's true. Yeah, me doing puppy dog eyes at the top of these podcasts. Hello, please. Anyway, bye.
Bye. That was awesome.